Welcome to Invest Education Hub. Today, we're exploring one of the most powerful yet overlooked ways to build long-term wealth: dividend stocks and dividend ETFs. These aren't just investments that pay you back, they're strategies built on consistency, stability, and growth. Whether you're just starting your portfolio or expanding it for the long run, understanding how dividend income works could completely change how you see passive income and financial freedom. If you believe in building wealth with discipline, not luck, make sure to like this video, subscribe to the channel, and turn on the notifications, because every week we uncover the smartest ways to invest for your future. And that's really the core idea here, right? We're talking about a huge shift in mindset. It's about moving away from chasing those quick, risky gains and instead embracing the discipline it takes to build real, sustainable wealth. It's kind of like becoming a part owner in a great business and just letting your money do the hard work for you.
All right, so here's our game plan. We're going to start with why dividends even matter. Then look at a few different ways to approach it, from super solid to a little more spicy. And we'll wrap it all up by showing you how to build your very own dividend portfolio. Let's do it.
Okay, so before we even think about looking at a single stock or ETF, we've got to talk about the single most important idea in all of dividend investing. Seriously, getting this one thing right, well, it's pretty much what separates the folks who succeed from those who fall into some really common and costly traps.
And that big idea is total return. Here's the deal, and you really need to let this sink in. A high dividend yield means absolutely nothing if the value of your investment is going down the drain. You know, you see that flashy 10% yield and think, wow, but if the fund's price drops by 6%, your real, actual gain, your total return is only 4%. You have to look at the whole picture. It's the income plus the growth that matters.
This right here, this is probably the biggest mistake I see new investors make. It's so easy to chase that shiny object, right? That super high yield, but it's often a trap, a red flag hiding a cliff's edge. The real goal isn't just the income. It's that powerful 1-2 punch of steady income and seeing your original investment actually grow in value. Now that is how you build wealth that lasts.
Okay, so you need to burn these three things into your brain. First, yield traps. Think of it like a high dividend on a sinking ship. Looks good from a distance, but you're going down with it. Then there's return of capital. This one's sneaky. The fund isn't paying you from its profits. It's literally just handing you your own money back and calling it a dividend, which shrinks your investment. And finally, NAV erosion. That's just a fancy way of saying the fund's price is slowly bleeding out. Being able to spot these pitfalls, it's everything.
All right, now that we've got that foundation laid, let's build on it with our first real strategy: dividend growth. Honestly, this is the bedrock. It's the engine of long-term compounding, and it's where most really successful dividend investors start their journey.
So with this strategy, the goal isn't to find the highest yield you can get today. Nope. It's about finding these incredible, high-quality companies that have a proven track record of increasing their dividend payouts year after year after year. The best way to think about it, it's like your investments are giving you a pay raise every single year. And that is where the magic of compounding really starts to take off.
Okay, let's look at two of the heavyweights in this space, SCHD and DGRO. And what's so interesting here is the choice they present. Look at SCHD. It gives you a higher starting yield, almost 4%. Plus its dividend has been growing at a crazy 11% a year. DGRO, on the other hand, starts with a lower yield, around 2.2%, but its entire reason for being is finding companies that are growing those dividends. So you have a choice to make, right? Do you want more cash in your pocket today with SCHD? Or are you playing the long game, betting on faster dividend growth in the future with DGRO? It just goes to show you, even within one strategy, there are important little differences.
But, what if you need more income right now? Maybe you're trying to supplement your cash flow, or maybe you're getting closer to retirement. Well, that brings us to our next category of ETFs, and this one makes a very, very specific trade-off. Now, this is a totally valid strategy, for sure, but you absolutely have to understand the trade-off. You're basically tilting your portfolio towards more mature, cash cow type companies. Think utilities, consumer staples, that kind of thing. They are fantastic at generating steady cash flow right now. But, and this is the big but, you're giving up the potential for that explosive growth you might see from a dividend growth fund.
Vanguard's VYM is the perfect example of this. It'll give you a solid yield today, something like 2.5%. But look at the dividend growth. It's only around 4%. So yeah, you're getting more cash in your hand up front, but that income stream just isn't growing anywhere near as fast as it would in a fund like SCHD. It really boils down to that classic investing question. Do you want more income today, or are you willing to wait for more growth tomorrow?
Okay, buckle up. We are now entering what I like to call the Wild West of dividend investing. This is where the yields you see are just massive. But you guessed it, the risks are just as huge. This stuff is absolutely not for the faint of heart. And let me be crystal clear, this is not a core portfolio strategy.
You'll see some funds out there, like TSLY, for example, which is based on Tesla stock, advertising yields like this, 151%. Just let that sink in for a second. A number that high, that absolutely unbelievable, means we have to pull back the curtain and see what's really going on.
So the first question that should immediately pop into your head whenever you see a number like that is this too good to be true? And I'm here to tell you the answer is pretty much always yes. It is. So let's break down exactly how these funds create that insane income and, more importantly, what the catch is.
First things first, this income isn't a traditional dividend that comes from a company's profits. Not at all. It's generated from an active trading strategy called a covered call. Here's the simple version. The fund owns a bunch of stock, and then it sells a contract that gives someone else the option to buy that stock later at a set price. For selling that contract, the fund collects a fee. They call it a premium, and then it passes that cash on to you. So, in a way, it's generating income today by selling off some of its potential for future growth.
But this kind of income comes with a really steep price tag. For starters, your potential gains are capped. If the stocks in the fund suddenly shoot for the moon, you miss out on a lot of that rally. Second, you've got that NAV erosion risk we talked about. The fund's price can just slowly wither away over time. And then there's taxes. These payouts are often taxed as regular income, which is a much, much higher rate than qualified dividends. And that's exactly why these funds should only be thought of as tactical tools for very specific situations, not the foundation of your portfolio.
So, the big question is, how do we take all these different pieces and put them together into a smart, personalized strategy? How do we balance safety, income, and growth? Well, we're going to do it using a really simple, time-tested approach to building a portfolio. It's called the core satellite approach, and it's a proven method used by tons of successful investors. The idea is actually really simple. The biggest part of your portfolio, your core, is made up of those stable, reliable, foundational investments we talked about. Then you use smaller satellite positions to kind of tilt your portfolio in a certain direction, whether that's adding a little extra growth or boosting your current income. And this chart here shows you exactly what that looks like in practice. See, a huge chunk, 70%, is your core. That's your bedrock stuff like SCHD or DGRO. Then you've got your two satellites, maybe 15% in a growth ETF to capture more of the market's upside, and another 15% in something like VYM just to give your current cash flow a little boost. It's a beautiful, balanced approach.
So here are the steps, plain and simple. First, establish your core. Put 60 to 80% of your money into those foundational dividend growth ETFs. Second, pick your satellites. Add those smaller positions to tilt your portfolio towards your personal goals. Third, and this is a big one, think about taxes. Try to put those high-income, tax-inefficient funds into a tax-advantaged account like an IRA. It can save you a ton of money. And finally, number 4, review your portfolio and always reinvest those dividends to let the awesome power of compounding really go to work.
Dividends reward patience. They prove that true investing isn't about timing the market, but about owning a piece of it and letting time work for you. Keep learning, keep growing, and remember, your best investment will always be in knowledge and consistency. Thanks for watching, and I'll see you in the next video.